calling this segment Community Mortgage Revisited. And the reason I'm doing this is I'm really excited about the program, in part because I'm about to start a transaction where we're going to take advantage of this product. And I think it's really going to work out well for the particular situation that I'm involved in with a borrower. Now, what is this all about? Well, first of all, just so you know, this program is through a lender who is what's called a CDFI, a certified, now I've lost my train of thought, a certified development financial institution. And the idea is what this program provides is prime mortgages, but without having to document your income, employment, or your debt to income ratio. So again, you get a prime mortgage without income, employment, or DTI documentation. And by the way, that CDFI, it's coming back to me now, Community Development Financial Institution. They're certified by the U.S. Treasury Department. And so that's what's so unique about this program. This might sound crazy. You can get a loan without documenting your income or where you work and without a debt to income ratio being calculated. Yes, that's true. And part of the reason they can do that is because they are a community development financial institution certified by the U.S. Treasury. And the whole point of this product is really to address and to target an underserved market in the mortgage industry. And so I think this program does very well with that. And some kind of bullet points about what this program features. It's available on primary residence and second homes. And by the way, on the second home issue, the rate's the same. So there's no markup in the rate for a second home versus a primary, as is now the case with conforming lenders and conforming loans. Of course, that happened a year ago where the agencies, Fannie Mae and Freddie Mac, now price second home loans as if they're rental properties. In fact, the rate on a rental property, the rate on a second home is going to be the same as the rate. They're going to be the same rate. It used to be a second home rate would be the same as a primary residence. That's no longer the case, hasn't been for over a year. The other thing is on this program, your loan is underwritten and approved based on your loan to value, based on your credit score, your FICO, and your liquidity. You have to source, you have to verify the money you have for the down payment. So income is not documented. Employment is not documented. In fact, those are not even put on your application at all. Your debt to income ratio is not calculated. So this is also known as a no ratio loan because you don't document your job, you don't document your income, and we don't calculate your debt to income ratio. And the other nice thing about this product is in terms of verifying your liquid assets for the down payment and closing costs, we only have to verify those assets for a 30-day seasoning period. So no longer, at least with this product, do we have to get 2 months bank statements or the most recent quarterly statement. 30 days of the seasoning, meaning one monthly bank statement or account statement, is going to be sufficient in most cases. And in fact, with some accounts where maybe you have automatic deposit of your paycheck, with that kind of situation, we only need the first page of the bank statement to show the starting and ending balance. We don't need the rest of the pages. So the issue of where you work at and what your income is from your job doesn't even come up. So what kind of borrowers is this really good for, or who is really targeted with this kind of program? So let me give you a list, because chances are maybe you or someone you know might fall into one of these categories. The basic idea here is that this program is for borrowers who are the type of borrower who are unable to qualify based on debt to income underwriting. And you know what? There's a lot of borrowers out there who are good credit risks, but they're not able to meet this qualifying based on the debt ratio. So what kind of borrowers are we talking about? Well, the most common is self-employed small business owners. Another very common one is someone who has a job history that's volatile or irregular in terms of employment. And then another common one, particularly out here in the desert area, retired borrowers. They may have plenty of liquid assets. They may have very limited income, either from a job because they are retired, or maybe they have limited monthly income from retirement, whether it's Social Security or pensions, what have you. Maybe don't have a pension. So they may be asset rich, but monthly income poor. This is a great program for that type of borrower. Seasonal workers or gig workers. In fact, out here in the desert, we do have seasonal workers who work in hospitality during the summer. Some of the places that they work at, country clubs, et cetera, essentially closed down. We've got, people who are, farm labor who are seasonal. A lot of times they don't work during the summer months because that's not the growing season. It's too hot, etc. Of course, gig workers are very common. Another type of borrower that this program is good for and serves is owners of employees of cash businesses. There are a lot of cash businesses out there. So if you own one or you work for one and you're paid strictly on a cash basis, this is a great program to take advantage of. Of course, if you have the down payment money. If you're someone who changed your jobs, maybe entirely into a new industry, it's not related to your job history at the time of the change, you don't have any sort of education or training that you can document to support the new industry or job you're in, which can create problems in getting qualified for conforming loan. This is a great program for that kind of employment history challenge. You may have some transition from recent health, family, or other life events, which can, certainly be an issue in terms of interrupting employment, interrupting employment income. So again, this is a program that's really good at helping that kind of borrower. And lastly, this program is available on refis, both second homes as well as primary. And this can be a way to unlock trapped home equity in a situation where maybe you're one of these types of workers or borrowers that I just described, upper portion of this list, and you already own a home, you've got a lot of equity. This is a good program that'll help you tap into that without going, again, through that debt to income underwriting. So I really think it's a great program. I really want everyone to know that it's available to you or someone you know who are facing these kind of challenges and have been frustrated by the inability to get mortgage financing, even when they have some down payment money. The reason I bring up the down payment money is this program does require a minimum of 20% down. But guess what? The loan amounts can go up to $3 million. And again, for both primary and second homes, of course, that's a big issue out here in my area where my office is, and other parts of California. So this is got a very good use for that kind of borrower and the type of property that they're purchasing. So keep that in mind. I'd love to talk to any of you or anyone you know who is in need of this kind of approach to get mortgage financing. Don't hesitate to get in touch with me, obviously. Thanks everybody for watching. And just remember, at MortgageWorks, we have the answers and they're on the house.